Welcome back. Welcome back. My name is Kyla P. Barnes. I am your financial chef and coach. I hope you had a really good holiday season. I know I had a very amazing holiday season. In fact, it was so amazing. I'm late producing this video, but that's okay because I wanted to get in touch with you, all my viewers, my subscribers, the naysayers, as well as those people who are just surveyors, just to speak to you before the end of the year, wish you well as put a few things in your ear that maybe may work. As always, you can book a consultation with me, or you can watch these videos for free. You know, it's up to you. But when it comes to an actionable step that will grow or protect your portfolio, if you don't have the will, skill, or time, you may need to have someone in the seat or walking with you or partnering with you to get to your destination that you really want to go to. I'm going to open up the video with some awesome music because I like music, let's be honest. Right now we're listening to Christian Full of Smoke, but we'll also hear Jacob Banks, Aloe Black, Rag and Bones, and Shade. So those are just few of the music selections that are going to be playing in the background. A lot has occurred, but what's new, right? That's been the whole 2020, that's been the whole 2022 year. My apologies for that. Let me just turn this down just a little bit here. All right. Let me know if that's too low or too high in the comments. I can adjust that for the next video. It's going to be really hard to adjust that for this video, though. As always, this is one take, one message, so I apologize for stuttering, looking at notes, as well as just thinking out loud, but that is how I want to send my videos out to the world because I feel like that's what you get if we met in person anyway. So I have a lot of notes. I know that's a blank sheet of paper, right? False alarm. But I do. I have a lot of notes that I have been taking as far as the month. I even have these notes here that were on a calendar cycle, just because I want to make sure that there were several topics that I touched, as well as tried to cover with you before the year was out, and then also before we close out the month of January. So again, happy holidays to you and yours. Hope everything was somewhat kosher. Even if you had to be around family you could not stand. Hopefully it wasn't that bad. Also, hopefully you got a gift that you wanted. And if you didn't get a gift that you wanted, hey, that means you don't have to give another gift. Or maybe you just gave the gift of time, which is going to be most pertinent anyway. It's going to be probably one of the best deliveries that you can give someone because it matters the most. And you can do whatever you want to do in that time segment, right? So it's just what I feel. But let me know how your holiday went. I am open for all thoughts as well as just conversation. You know, that's what I'm here for. So as always, I usually open up with a quote. I have a few quotes here, and I also have a heavy bit of focus on just perception throughout this video. So the first quote that I captured in the last 41 days was, "Volatility is a temporary financial condition, but financial freedom is forever." I really like that. The other quote that I found that was really poignant is, "In times of crisis, the wise build bridges and the foolish build barriers." That was from Chadwick Boseman, Wakanda Forever. Also, there was one more quote that I want to share with you. It says, "When you tell the truth, it becomes a part of your past. When you tell a lie, it becomes a part of your future." When I heard that, I was like, wow, that's real deep. Especially when you think about how many lies you may have told that no one figured out. Or if you think about when you told the truth and it cost you, right? At least it set you free. It was a part of your past, and you don't have to go back and jog or curate any story because you just stated the truth as it was. So those are my three quotes. Let me know what you think about them. When I recap the last 41 or 30 days as a whole, the Fed did move consistently in the month of November as well as in December. So our target, the Federal Reserve's target rate is now within the window just shy of about 5.25%. That is extremely high comparative to the last few years, but the Fed did start moving aggressively in the 2022 year, which led us to those higher rates. Numbers that drive the Fed to move are inflation, which inflation has been lower since June of 2022, so that's good. But it is still higher from, like, let's say 3 or 2 years ago. COVID drove a lot of those precursors that led inflation higher. And while some of them are correcting, many of them are still somewhat offline. So that's something to keep in mind. Right now, I have inflation up 0.1 for November. I had it up 0.4 for October. So year over year, that puts inflation up 7.1%, which is significantly higher than what the Fed prefers, being under 3%. The good thing is that we still have unemployment intact as of right now. Unemployment is at 3.7%. That's been holding kind of steady. The Federal Reserve did meet November 1st or the 2nd. The very next Federal Reserve meeting is going to be coming up January 25th through the 26th, where they will review the balance sheet, they will review their budget, and they'll also review the rate environment at that time. Retail sales are slumping. Consumers didn't go out there and hit the streets as much as they were expecting. Keep in mind that retail sales and consumer confidence is a very, very large part of GDP, because GDP is driven by 17% personal consumption, 4% net exports, 17% business inventories, and 17% government spending. So if the consumer is 70% of that, we really have to observe how much the consumer is in the seat and how much they're really spending. So it looks like at this current time, consumers are not feeling really that bullish. I mean, when you think about your own habits, are you feeling bullish? Do you feel like this is the time to go out and spend a lot of money? Or do you feel like maybe this is the time to spend wisely? You know, because if you're contemplating some of these thoughts, someone else is contemplating the exact same thoughts as well. And if you want to talk about this, or if you want to explore this topic a little bit more, I am welcome to do that as well in a consultation, or maybe you'd like me to cover a certain financial topic, which we can review in this video or another video in the future. Let's see here. Housing starts are down, but we knew that because the interest rate environment is higher. Anytime the Federal Reserve comes in there and hikes interest rates, leisure items usually pull back. Home sales usually pull back. Home starts usually will clear the pipeline for what was already slated to be done. They'll usually get those out because raw materials become higher. The other thing that usually rises when or decreases when rates become higher, or we possibly move into a recession, is technology. It pulls back a great bit as well. Bitcoin right now is still flat. That is a very interesting trade to me, especially as it relates to the news that's been going on, especially with the FTX Sam Bankman-Fried and him being subpoena extradited, possibly to the United States for trial, but mainly at this current time, his firm has filed for bankruptcy, or is in the stages of filing for reorganization towards bankruptcy, because he did very bad things with clients' money. I'm trying to say it nicely, but he's in some pretty hot water, especially given that his firm went from being 33 billion down to maybe 19.6 overnight. So that's something to be concerned about. It's also something that if you're in the Bitcoin space, I think you should monitor. If Bitcoin is your trade, it's not for me. I think that's something that you should monitor, because across the board now, there's the big question of, well, should we monitor Bitcoin, how do you evaluate Bitcoin? How do you assess from an analytical standpoint if the balance sheet is really valid or if it's just kind of like a stated balance sheet, which is what sometimes happens with oil reserve companies or master limited partnerships. They have to gauge what the worth is, even though it has not necessarily came out of the ground, been mined, and off to its final product. So that is something to be mindful of. If things were bullish for Bitcoin, we could see a swing, but if it was not, then we'll continue to see a further decline. Let me know if that is something you want to discuss a little bit more, or even if this is pertinent to you. As far as currency, the Great British Pound came back online, so that's good. Right now, month over month, it's about flat. For the year, it looks like it has bounced off of the October lows. The same thing is happening with the euro. The euro right now is, for 1 month, it's up. For 1 year, it is up also off its October lows. There was one point in time the euro was actually lower than the dollar, but at this current time, it looks like the euro is definitely racing back. 1 euro equals about 1.06 in US dollars. $1 would provide 0.94 euros. So that's what I mean when I say the euro is racing back. There was a time earlier on in the year where the euro was about 1.15. So at that current time, that does mean that if you had a euro to dollar, of course, you could get more, but dollars to euro, you would get less because that currency was higher. Let me turn the sound down just a little bit here. All right. Let's see here. So we have consumer confidence continues to slide, which is a bearish factor. Savings yields, because of the Fed, have really polished the brass here. Savings yields right now for a CD 1 year, you can get 4.3. For a 2 year, you can get 4.7. For a treasury, you can pick up 4.25 for 1 year or 4.44 for a 2 year. And bonds right now, investment grade, you can get 6.88%. So how do you use this information? Well, if you see anything sent to you by your bank, your credit union, or even your firm, and they're just like, hey, we'll give you 4% for a 5-year CD, decline that value, because at this current time, you can get 4.7 or 4.5% for a 2-year CD. And it's not to say that the environment is going to change 5 years out, but it is to say that if the stock market repairs itself, then the better value would be to have more equities and less fixed income relative to where you are in your financial and retirement journey. So just be mindful of that. I've seen some literature come to my house, especially, and it said you can get a 3-year CD for 3.33%. I was like, you got to be kidding me, because I know that I can pick up a 3-year annuity for 3.7%. Is it relevant to my age right now? Not really. But I can also pick up a 3-year CD for 4.55%, or I could step down and get a 2-year CD for 4.7. I can get a treasury, just like you. When I say I mean you. I can get, or we can get, a 3-year treasury for 4.21%, or we can get a 2-year treasury for 4.44%. We can also get an investment grade bond at 3 years for 8.08% with a company like Goldman Sachs, like Ford, like General Motors, like the Chicago Mercantile Group, like I'm trying to think of who else I saw out there, like BMW. They also have a higher rate bond out there as well. So when you see these solicitations in the mail, just be mindful that those banks need your money. They need your money just kind of like you need your money. So all I'm asking is that if you have some time, do your work, make sure it counts, and also put that money in your pocket. Your money looks better in your pocket than it does in somebody else's, and that's just my own personal opinion. Stocks right now are down. Well, they've been down the whole year. Yeah, I think that's about fair. Stocks have been down the whole year. Right now, the S&P is down 19.33%. The NASDAQ is trailing at about 26% negative. The Dow is actually down under 7%. I had a rally here in November. So that does mean that at a 5-year span, looking just at the S&P, you would be at a yield of about 9.29% if you were invested in something that was close to the S&P, an ETF, an electronically traded fund, or if you were invested in the larger of the assets in the S&P 500, which there's less than 20 companies that are controlling most of the float of the S&P. I don't know if you knew that, but if you do know that now, you're accountable that when you're looking at the S&P, it's truly a heavier weighting on 20 plus companies, like the Dow is a weighting on 30 companies. So just putting it out there for you. Let's see here. Covered yields. I-bonds. The I-bond rate has slipped from 9.83%. It's now at 6.89%. I-bonds is really an interesting product. I've had the year to be able to cover just like, is this worth investing? The good thing about I-bonds is that they open really low. I want to say they open at about $25. I'm going to go back here and look and see how, yeah, they open at about $25. It's best to keep them in for at least 5 years. So don't get your $25 out unless you really, really have to. But the I-bonds open at $25 and they're paying an interest of 6.89%. If we use the rule of 72, which means that if your money was to produce a certain interest rate, how long would it take for your money to double? The way that you find that answer is you take 72 and you divide it by the interest rate. So on your calculator or on my calculator, I'm going to take 72, divide by 6.89%, which is the yield on the I-bond at this current time. That means that in 10.44 years, your money will double. So your $25 is going to double in an I-bond in 10.44 years. In addition to paying interest. The interest is what's going to make it double. But if you were to invest something larger, well, now you're in some real business because just like with any investment portfolio, you have to balance your real estate, you have to balance your fixed income, your cash, your international. And I-bonds have proven over the last 20 plus years to have been a real contender to the U.S. Treasury. Well, I mean, it is actually a U.S. Treasury item, but it has such a great rate. You know, like when you look at 6.89%, and if you were to compare that to a yield curve right now, you could probably get a 2 or 3 year investment grade bond, which is going to be triple A, double A, single A, or triple B. You can get that for 2, 3, or 5 year, just depends on the company. But that 6.89% is a rate that recently just came after their November recalibration, or October. It's either October or November. It could be October. And so that particular investment, just work with me, right? So if you had $1,000, I'm choosing a low number, that's okay. If you had $1,000 and you multiply that times 0.0689, we have to move it to adjust for dollars, you would get $68.90 a year. When you multiply that number times 10, you'll get $689. When you multiply the number, just straight interest, times 2, you'll have $1,378. That's for 20 years. Now, I know you're probably thinking to yourself, Kyle, I'm not going to wait 20 years to get $1,378. And that's fair. You don't have to. But this is only $1,000 of your money. So If you can park 1,000 and allow for it to grow and do its own thing, and all the other thousands of your money you put into other investment items, just imagine where you'll be. You know, if you did this with just $10,000, with some in I-bond, some in equity, some in mutual funds, some in fixed income, some in money market, at this current rate environment, you could probably average maybe 7.5, you know. I think that's something to hang your head on, especially depending on your portfolio size. Let's see here. So before this video gets too long, which I can go on forever talking about this, because as I mentioned, I have 9 pages of data that I have to try to cover, but that's what I do. That's what I like. 2022 was a challenging year. It was. And I think I may actually do 2 videos as well on this, but 2022 was a year in which it was a reflection of yourself, of your choices. It was also possibly even a reaping year. So whatever you sowed in the other years, biblically speaking, you would have reaped in 2022, because 2022 was a year that didn't offer much. So if you needed to take some from the table, well, this becomes a time in which you can take some from the table and you can eat off of it. It is my opinion, just my opinion, that some financial models are guided to very passive investors, or to give investors a very general idea of where they should be. As you get into your finances, as you manicure what's best for your finances, you will be able to see for yourself some financial models don't work for you. You'll also be able to see for yourself some trends don't work for you. And it's okay. It's okay that certain trends don't work. For the 2023 year, here's my forecast. You ready? Here it comes. On a sector level, there's 11 sectors. On a sector level, I believe energy is going to be a winner. So that's energy. Industrials, healthcare, staples, utilities, and maybe material. I believe that there is a lot of value in the possibility that we could go into a recession, but I believe also that we've seen some of the aspects of a recession already. We've seen higher prices, we've seen lower demand, we've seen stores close, we've seen supply chain dry up, we've seen logistics fail. These are all aspects of a recession. In addition, unemployment has not risen. It's at 3.7%. Consumer purchasing has decreased. We've seen bankrupt businesses. Home foreclosures are not nearly as high as they were in 2008 and 2009. Also, there are several jobs out there. The employers may not necessarily want to hire unless it's top talent, but there are quite a few jobs out there. So that means that with several of these things already happening and some not happening, I believe that the true recession may be a 45% likelihood, and I'm going to go out on a limb and say it will be less than 7 months, and it'll show up to the GDP chart just about as minuscule as this year. That's my forecast. I don't have a crystal ball, but it's what I truly believe. I also took a look at all of the S&P industries. The GSCI has 24 industries inside of those 11 sectors, but there really are more than 24 industries. When you actually get into the weeds, you'll see it's more than 50 plus industries. And that can range anywhere from textiles to airlines to semiconductors to oil, tobacco, different things like that. So I'll give you my top three, right? I'll give you my top three industries. I believe airlines is going to be a contender for the 2023 year. I do. Entertainment, I think, is going to come back online. Right now, it's down by 42.88%. Airlines are down 16.44%. Semiconductors are down 35.66%. Semiconductors is a trait that when it comes back online, if you're positioned for it, it's really going to make your portfolio. But the problem being is that so many things have to correct on a global scale for semiconductors to come back online. So I have a newsletter that I create every month, and I can cover a little bit more in depth all of the industries I believe they're going to come online, and some I just don't think it's going to be worth your time. My newsletter also tells you how to trade, what to look at, pitfalls to avoid, and things that round out your year. When I look at my year, wow, real talk. When I look at my year, the 2022 year, I am thoroughly impressed. I am a child of God. I am a Christian. Yes, I like to curse, and yes, I do sin, but hey, don't judge me. But when I look at my 2022 year, I am just mesmerized. There are some things that I knew I could do well, but having the time to harness it, I did that flawless. You know what I'm saying? And one of the things I was able to eke out for the 2022 year was actually a positive gain. So yeah, my assets grew by 5.14%. And I have to just give credit to the creator, because time is something that I think we all underappreciate, because someone is always telling us what our time is worth. But when you go out on your own to define what your time is worth, whoa, your health gets better, your perception gets stronger, your focus is more laser, priorities are ironed out, and your personal growth becomes a higher priority than how much you can make. Yeah, so I had a lot of positives for the 2022 year, and I'm grateful, highly grateful for everything that I was able to accomplish this year, all the people I met, all the stories we shared, all the laughter we shared, because that was amazing. But the 2023 year is going to require for you to be intentional about the things that you need to be intentional about. Don't do anything just half-hearted. If you don't want to do it, don't do it. Also, failure is imminent. So if you want to get to whatever level you need to get to, you got to go out there, you got to try some stuff. It may not work, but that's okay. You try. And also, I believe you're going to learn something from that try. It's not just going to be a straight fail. So understand that failure is part of the process to grow, and also part of the process for you to grow. Indeed, knowledge is elevation. Check us out online and subscribe.